Show the audience. Alright, Joe, whenever you're ready.
Hello, I'm Joseph Smith, and this is my informative speech on how to begin investing in the stock market. Investing is not as tough as you may think. It is quite easy, and with some simple tips, you can do it yourself. It also doesn't require as much cash as you may think. I find interest in this because my major deals a lot with this topic, being an accounting and finance major. My studies have taught me to start saving now, as it'll pay off in the end with retirement. The topics that will be covered in this speech include the types of brokerages that are out there, the types of investments that are out there, which is a lot, and also how to handle your portfolio once you get going. The first part about investing is finding a brokerage. Capon, a writer with Forbes, says find what fits you, because what fits you will be best for you to start investing. There are full-service brokerages, which D'Amato says are very expensive, even though they offer retirement planning, investment help, and also research. These are good when you have a lot of money. Two of the biggest ones are Edward Jones and Merrill Lynch. There are discount brokerages as well. These are much easier to start with. They offer cheap trades, Scottrade offering $7.95 per trade, and E-Trade offering $7.99 per trade. These are the way to go when you don't have as much money and want to start getting to go. There is no research, they don't do financial planning for you, but they are good. The startup cash you will need is at least $500, as the discount brokerage uses $500 as the minimum balance. Save slowly from work. Break the paycheck to paycheck cycle. This may be a hard habit to break, but it is possible. Warren Buffett says if you do this, you'll be a lot better off. He says save before spending instead of saving after you spend. There's a lot of research out there to do though, and it may be time consuming, but it is well worth it, as you don't want to get involved in the wrong stocks. There are many opportunities out there, including stocks, bonds, CDs, ETFs, mutual funds. So you have a lot of options. To start off, think of a few companies that you truly like. If you could write a paper out on why you should invest on them based on their fundamentals and the reasons you like them, then it probably is a good company to invest in. There are many places that say to do that. Find a hot sector as well. This could be easy. You would go to Google, or even Scottrade or E-Trade would be able to offer you to see what sectors are heating up and what sectors are good right now. It is smart to go with blue chips. Your blue chip stocks are your biggest companies, like Facebook, Apple, Google. These are blue chip stocks. They perform very well, as you know they're going to return a good income. If you don't have time to do all this, that doesn't mean you can't invest. There are ETFs and mutual funds. ETFs are a few stocks that would be combined, like Google and Apple and maybe even Facebook being internet stocks. You could buy an ETF with all three of those in it, and it would perform with consideration to those three. Mutual funds are much larger and could have a lot more things in it, from bonds to stocks and different companies. But they're both good routes, and Vanguard offers many good mutual funds and ETFs. Now the main thing, watch the fundamentals. Pekansovich says that these are the keys to investing. The PE. PE is the price to earnings ratio. A PE of 20 to 30 is very good. This means that the company is earning a profit and isn't overvalued when you're purchasing it on the stock market. Also, there are many other things to look at. Your Morningstar ratings. Morningstar does many ratings for each company, which means they will tell you what companies are good or bad. Also, look at the balance sheet. You can see the earnings, what the company has in assets, and their debts. This is very good to do because if your company is in debt, you don't want to be invested in them. Also, check out the upcoming events. This is important because you will see if a company is going to start putting out new products or something good, or even if something bad is about to happen to the company. And look for dividends. Dividends are easy cash that a company will pay out from their earnings. Determine the company's position. Like I said, if you can determine if they're making a profit, you will be good to go with investing. And look for surges in profit. If you see a large profit increase in a company, that's a good company to invest in, because they're going to start performing well on the stock market. Now, once you're invested and you found your companies, it's time to keep your portfolio going. Don't check daily. Checking daily is not good. You'll make bad decisions when you're checking daily, as you will see the day-to-day swings of the stock market, but in the long run, it's going to be alright. You're going to make a profit because usually the stock market is going to go up. It takes time, but don't sell and buy daily because you will lose money. Even Warren Buffett says that. Read up on news reports on your company that you have now bought. You are an owner. And if you find a company that you are actually interested in, this is easy to do because you already have interest in this company and you want to find out what they're doing. Continue to look for new options because they are out there. And there are many. As I said, there's the stock market, you have ETFs, mutual funds, CDs, everything. And there are millions of companies out there to be invested in. When it comes to taking profit, you always want to, no matter how big or small it is. If you could take a profit, you're going to be okay. If you're happy with what you made, sell the stock. It's alright. Don't go chasing. Don't get greedy, because that's when you get hurt. Leon says you can't lose when you're making a profit. If you take the profit, you'll always be ahead, and you're always going to keep acquiring money. Don't sell when it goes down, because usually it'll come back. The only way you could actually lose money is if you sell it for a lesser price than what you bought it at. The power of interest. Interest builds up over time. And the longer you leave your money in the stocks or anything else, it'll be better. And you'll make more money. Over the last 100 years, the average return of the stock market has been about 6%. In conclusion, I hope I have given a lot of information for you to be able to invest in the stock market now. I hope I made it a lot easier, and I took a lot of pride in doing what's with the stock market, being an accounting and finance major. I'd like to thank my audience for being attentive and listening. And just remember, there's a lot of options out there to invest in.